Hi, I'm David Lin. Welcome to Kitco Insights Interactive Outlook 2023 series brought to you by Verified Investing Education. We are living currently in one of the most turbulent times in the modern era. 40-year high inflation has ravaged economies all around the world, forcing central banks to lift interest rates at record paces. The U.S. Federal Reserve has already raised rates 6 times this year, with more expected in 2023 until Chair Jerome Powell's job is done, quote unquote. This, alongside 20-year high mortgage rates, have seriously hurt consumers' wallets as well as consumer sentiment. Can the S&P 500 and other stock indices recover to its previous all-time highs next year? Will Bitcoin bottom soon? Is there an end in sight to the crypto winter, which has recently been exacerbated by the collapse of FTX, then the second largest exchange in the crypto world? How should investors, most importantly, how should investors and traders navigate what is possibly a very serious recession in 2023? Well, joining us to discuss these themes and very important questions and much more is somebody who has correctly called the direction of the markets this year, Gareth Soloway. Gareth, it's always a pleasure to have you back on Kitco. Honor to have you back, man.
So we meet again, David.
We meet again live. Last time we did this in the summertime, and for those of you who missed our last show and who doesn't know who Gareth is, a brief introduction. A very accomplished trader. Gareth is the founder of VerifiedInvestingEducation.com and the chief market strategist at InTheMoneyStocks.com and VerifiedInvestingCrypto.com. He is an accomplished technical trader with over 20 years of experience and follows Bitcoin, stocks, gold, and oil. Gareth has already made a lot of money trading the markets and wants to now give back to the trading community through the Verified Investing Education series, in which he reveals his top trading secrets and tips. Gareth's claim to fame in the last year is the correct calls he's made. Back in November 2021, when Bitcoin edged towards $69,000 a coin, its then all-time high, Gareth called for a correction to take place immediately, even when many people, Bitcoin bulls especially, were calling for prices to reach above $100,000, which it never did. Gareth stuck to his guns. He stuck to his medium-term outlook for Bitcoin, and eventually it did hit $20,000 a coin. It's target for Gareth in 2022. This was a call that he first made on Kitco way back in September 2021 during the heart of the crypto bull market. Gareth has also made a number of correct calls regarding oil. He said that should oil hit $130 a barrel, it would retrace immediately, which it eventually did. WTI crude is now targeting just above $70 a barrel. Gareth also said that gold would outperform stocks and Bitcoin in 2022, a call he made in October last year. And so far, that call has been correct. We will be revisiting these calls and outlooks with Gareth Soloway for all of these asset classes that I've mentioned. And stay tuned until the end. We will reveal his top asset for 2023. So stay tuned until the end after the question and answer period. We will be taking questions from the audience live about 30 minutes in. So start submitting your questions now in the live chat box. And please make sure to hit that Kitco subscribe button. Before we get started with the topics today, we do need to make a special announcement. If you do send your email to VerifiedInvestingEducation.com, you will have the chance to win not just the entire education bundle, but also some personal time with Gareth Soloway if you have some trading questions that you want to ask him directly. Well, with that said, Gareth, welcome to the show. I want to start straight into talking about the Federal Reserve and your bigger macro picture predictions for the coming year. Now, the Federal Reserve is slated to meet next week, a very important meeting, the last meeting of the year. They are expected or telegraphed to raise interest rates by 50 basis points, according to Jerome Powell's latest statements at the Brookings Institution a few weeks ago. Now, this is in line with what the stock markets are currently pricing. You remember, back then he made that announcement. We had a big spike and a big rally. What do you think they're going to do going forward then? I mean, we know they're telegraphed to raise 50 basis points. Should they not surprise the markets? That's on the table. What's after that?
Yeah, so you're right on that. 50 basis points is what the market's pricing in. I think that's a no-brainer for next week. My guess is that they'll go to 25 basis point hike after that. And again, I'm looking at the symmetry of what they did, right? When they started raising rates, they started with a 25, they went to 50, then they had 475 hikes, and now they're kind of coming down the mountain on the other side with a 50 and likely 25. And I think by the end of the first quarter of 2023, they're basically not hiking anymore. But the kicker is they're not going to be cutting rates either. And I think that's going to be the shock for the market.
You know, it's interesting because if you look at the previous rate hike cycles, going back to the last 20 years, each rate hike was not as dramatic as this current one that we have. But you're right, the rate stayed consistently high for usually around 6 to 8 months, I believe, was the average time frame of sustained rate hikes before the Fed lowers rates again. And so this time what Jerome Powell is saying is that he's made it very clear he's not going to stop until the job is done. He's also said very clearly that he doesn't want to loosen monetary policy too soon. He said that that has been a mistake that the Federal Reserve has made in the past. So how long do you think the Fed can keep rates high even if they stop raising rates?
So I do think inflation will remain elevated, right?
Yep.
And elevated to me means 3 to 4%, maybe 5%. So again, it's already coming down. We know it's coming down. Oil prices have come down quite a bit. That's helping bring inflation down. But the key is does it go back to 2 or under percent, which is what the Fed wants? And my answer is no. The wage inflation is going to be sticky. Always keep in mind that when people get paid double what they were making, it's not like that business can double the price of an orange the very next day, right? So it has to be passed through over the course of a series of, let's say, years. And so what's going to happen is you're going to see prices incrementally move up year over year to compensate for the hike in wages that we've seen around the globe. And I think that's going to mean that inflation stays north of 3% for at least 2 years.
Okay. I want to talk about inflation in a bit more detail in just a bit. But going back to your point about 25 basis points on the table, does that mean that markets will take that well? Because 25 basis points is somewhat more dovish than what we've been seeing. Like I mentioned, they've raised rates by 6 times already, 0 to 4%. Pretty dramatic in 1 year. 25% relatively, 25 basis points rather, relatively speaking, is quite dovish.
Yeah. So 50 is already, we saw that little rally off of the 50, kind of the guiding to 50, and then you're going to look for 25. And the market is going to like that as long as the economic data doesn't start falling off a cliff.
Right.
All right. If we start to get to that point where bad news is actually bad news, because remember, right now, bad news has been good news because it means that the Fed is less likely to hike. When you get that bad news, it means the economy is slowing, so they're not going to raise rates as much. But if we get into that next period where you see bad news starting to become bad news again, then I actually think that it doesn't matter. The market will realize that the Fed's not going to cut rates, and bad news means we're slipping into a recession with no bailout from the Federal Reserve.
All right. We've currently got about 1,000 people watching us live. Spread the message to your friends. I know this isn't the World Cup, but this information might save your life trading-wise. So please spread the information to your friends and family and your colleagues. Get them to come watch and submit your questions live. Hit that subscribe button. Gareth, let's talk about the CPI data that's coming out next week. CPI is coming out now. 7.7% was the last reading. It's been coming down steadily since 9.1, which was the peak back in June. The narrative that the Federal Reserve is spinning is that inflation has already peaked.
Yep.
And it will never see 9.1% again, well, at least not for the foreseeable future. It's not 2%, it's not 9%. Where are we going to go?
So it is coming down. There's no doubt about it. And you will see a number that reflects that. And part of the issue here is that inflation is from the past year. So 12 months ago, how much has inflation gone up? Well, if we go 12 months ago, inflation numbers were already spiking. So what it's telling us is that, yes, the inflation numbers are still going up. We're still seeing inflation, but the rate of increase is slowing. And that's what we see in these inflation numbers that are coming back in. And I think that's a common misconception. Everyone hears, oh, the inflation numbers were better than expected when they come in, but it's not saying prices are going down. It's just saying they're not rising quite as quickly. So I think investors have to be ready for that. I mean, it means that the prices at the grocery store are still going to be going up over time, just not as quickly. And it's going to hurt the economy. There's no doubt about it that investors and retail Americans in general are going to feel the crunch in 2023.
They're going to feel the crunch from what exactly? From higher inflation or from higher interest rates or from a slower economy?
I think this is the crazy thing about it. It's all of the above, right?
Okay.
You have inflation, then the Fed's going to basically push us into a recession that they can't bail us out. And remember, since 2009, the Fed has just been printing us out of every trouble, whether it was, you remember obviously 2009, the collapse in the banking sector, all the bailout bailouts that went on in the quantitative easing that was started. Right. And then that basically continued. Then in 2018, we saw them say, okay, we got to start raising rates. The market threw this big hissy fit, dropped 20% in a matter of 6 weeks. They actually reversed and started cutting rates again. And then it takes you into COVID, and we know what happened during the COVID crisis with them printing even more money. And that was the massive printing of money that we saw. Yeah. And so it's really everything. It's the inflation numbers, it's the economy that's going to be slowing, and it's also just the overall kind of wear and tear that it does on the consumer.
Well, on the bright side, now is a good time to use tax loss harvesting.
That's right.
But for those of us who are just more forward-looking, let's talk about the housing market real quickly. Mm-hmm. Pending home sales in the U.S. down 37%, close to 40% in October. Yeah. That's worse than 2008. And I don't see a Lehman-style collapse just yet. People are free to go out and buy homes. We're not in a COVID lockdown. So what's going on?
Yeah, so there's no doubt about it that when you see the 30-year at 7% and home prices are still elevated, very, very elevated, there's not a lot of people that can afford that monthly payment. One of the best indicators of the struggles in the housing market, I got back from Boston 6 weeks ago, and I got into my Uber, and it turned out my Uber driver was a real estate agent, right? Yeah. So that tells you everything you need to know about real estate right now. I don't necessarily see that same sort of 2008 collapse yet, but it is something we have to monitor, and I think you have to expect that if interest rates are going to remain elevated, then home prices probably have 20 to 30% downside from their highs.
That is something that the Dallas Fed has even said. The government, the Dallas Fed, has issued a report recently saying that in a bad scenario, housing prices could depreciate a further 20% from current levels. And importantly, they said this could bring down consumer spending even more. Yeah. Because if you feel like your home is worth less, you feel poorer.
Well, it's the wealth effect, right? It's everything to do with 401ks that when the Fed talks the market down. And remember, the Fed has done that, right? They see the market rallying and they'll say, hey, listen, we're going to be more hawkish, and the market sells off. They don't want the stock market to be up to all-time highs because it creates this wealth effect where people say, hey, look at my 401k. It's worth X amount. I can go buy that new car now. And same thing with home prices. You know, your home, you bought it last year. You already made 100K on it, and it created this wealth effect. So it's all tied into this inflation that's going on. And I do absolutely think that this is one of the things the Fed needed to pop these bubbles. Now, the question is, can the Fed control the collapse? In history, they haven't done a great job of it. I'm doubtful that they can again.
Okay. Well, how does this sustained inflation level that you talked about, how does this translate to the markets? Let's start by talking about the stock markets first. And I do want to just spoil the thesis here because it is important to set it up. You have told me before in prior interviews, and you told me again offline just today, that you don't see the stock markets recovering to its previous all-time highs until several years down the line. We've seen a recent precedent for this, actually. The NASDAQ, following the the dot-com bubble burst in 2001, didn't recover to its previous 2000 level high until 14 years later.
Yep.
Is that going to happen again?
Yeah, I do think it is, and it actually could be worse. So I do think at least a minimum of 10 to 15 years. I want to show you some really cool charts here. So
let's take a look at the charts.
Here's the Dow Jones Industrial Average, and I'm going to show you guys why I'm showing this chart. So take a look at what we have here. You have this sort of pattern, which is basically this M pattern top in 1915 to looks like right around 1921. All right, and again, you're going to say, well, why the heck is Gareth going back to this period? And then look at the run that the Dow Jones Industrial Average had for the next, basically in the roaring 20s to obviously the Great Depression, the collapse, the crash of 29. And so if you look at that, and now let's just go right to the S&P 500. And this is where it gets crazy, right? So what we can see is that same sort of pattern formation from the dot-com bubble, the dot-com collapse, the real estate bubble, the real estate collapse, and then look at the massive run we've had. Now, a lot of people would say, okay, that's just a chart. It's just, it's a coincidence. But what you have to do is you have to delve deeper. And this is where I love being a student of history. And what you do is you look at what was going on in the early 1900s, 1915, 1920s. And what was happening was cars were becoming more and more the norm. Electricity was becoming more and more the norm. Well, what did that give us? It gave the consumer light at night. They could go out at night. They could go to speakeasies, spend money. They could drive more than, before cars, you were limited to the distance you could go if you wanted to go to the general store, right? And so you had all these things coming into play that created a consumer that could get out there and spend money. Then look at what the lending stuff was. in the 20s. I mean, there was lending policies that are very similar to a lot of the lending stuff that we're seeing. Now, if we go to the current times in the S&P 500, in the dot-com era, what do we know happened? The internet emerged. Right. And the internet basically gave, do you shop on Amazon?
I do.
Well, so do I. And think about that. Now you didn't even have to leave your house to shop and spend money. And so there's these coordinative factors that make me think that we're very similar to what happened in the 19 teens to the 20s leading into into the Great Depression. And I don't want to, it's hard for me not to jump to that conclusion, but I am very concerned that we could see something like that occur.
We're about to jump into the 20s.
Yeah.
The roaring 20s?
The roaring 20s.
Okay, so that should be good for the markets, not bad.
No, because if you look at the chart, if you look at this chart, look at the S&P run.
Yeah.
And then if we flip over to the run from the 20s, we're at the end of the roaring 20s.
Okay, we're running towards the end. We're running out of steam.
The same sort of movement is there.
Well, we're only going to run out of steam if people run out of money. Is that the case?
Well, think about it. Let's say housing prices drop 20, 30%. Let's say your 401ks, let's say the stock market goes down 50%. Now let's take it a step further and say the Federal Reserve will not be coming in to print money, because if inflation, let's say, is at 4 or 5%, how do they print trillions of dollars with the risk of inflation jumping to 20 or 25%? I mean, we don't want to be Venezuela. We don't want to be some of these countries where you have this kind of crazy inflation. So the question is, how do we get out of the next recession? And that's the question. I don't have the answer for that. We might just have to pay the piper at this point.
Well, we can speculate how the government might get us out of the recession, but more importantly, how do investors navigate this recession is what people here watching want to know. If it is indeed true, Gareth, that the next 10 years will look rocky and sideways and unfulfilling, shall we say, for the S&P 500, what do? Stay in cash?
No, not necessarily, right? There's always opportunities out there. In fact, bear markets give you one of the best opportunities to buy stocks.
Well, hold on.
Are
you talking about a bear market or just flatlining? Because there's a difference here.
No, I think we're actually absolutely in a bear market. In fact, I think 2023 is going to be even worse than 2022 in terms of downside in the stock market. But there are places to go, right? There's gold. I mean, gold, again, great performing asset. If you look back and compare the 70s and the early 80s in gold, it's an amazing replication of what we're seeing now. Yet we just haven't started the big move up in gold that should be coming. So there's lots of places to go. And I would say this is that, in general, long-term investors have had their field day since the Fed began bailing the markets out. It's now becoming more of a trader's market where you buy, but then you can't just say, hey, I'm going to tuck this away for 20 years. You want to actually just take the profits and run and then look to rebuy on the next dip.
Okay. Well, how much lower can the S&P 500 get then before we start bottoming and getting this multi-year, if not decade-long consolidation?
Yeah. So I think the S&P 500 has, at minimum, we're looking at going down probably to, just in 2023, we will easily see the 3,300 level, which is basically the pre-COVID level. So if you go back to COVID, the February of 2020 period, the S&P 500 was trading around 3,300. We've never retraced back to that level. So it makes full sense that at least we'll go down there. That's about a 15+% drop from here. That's the bear bull case. That's the best case scenario per the charts. Really what we're looking at is likely going a lot lower to potentially a trend line. And I'll show my SPY chart here. But we basically could be retracing in 2023 all the way down to about 3,000. I would say 3,000 or just below 3,000 is my kind of key zone for the S&P in 2023.
Percentage-wise, is that as severe as 2008?
No, not from peak to trough, but I'm not saying it's over yet.
Okay.
That's the key, right? So, and this is the other thing that people have to realize, that you can look at past recessions, like you can even look at 2008 and 2009, but you have to ask yourself, how did we get out of 2009? And the answer is the Fed came in and bailed us out. They started printing money. They started to do things like that. Now, what happens? How long can a bear market last when you don't have the Federal Reserve? And I think as investors, we have to go on that assumption unless we see inflation get down towards 2%.
Okay. Now, some people might argue, Gareth, being a contrarian, if this person were a contrarian, he might say that, look, because everybody is bearish right now and a lot of people do agree with you, now's actually the time to get back in.
Yeah. So I would dare say that people, this is not even close to the feeling when there's full out panic, right?
Okay.
And I think this would be seen. And I would say to you is like, is anyone really that worried? I mean, it's not fun to see your investment accounts down, but is anyone proverbially jumping out the window yet. No one's doing that. There's not this fear because we've been addicted to the Federal Reserve coming in all the time and just saying, oh, yeah, we're down 20, 30%, but the Fed will come out and save the day. What's going to happen when the Fed doesn't do that? And that's going to be where the markets really panic.
Will they do that? Let's take a look at another piece of data here. The Federal Reserve balance sheet has been shrinking ever since the beginning of the year, actually, the middle of the year, to be exact. And some people have noted that there's a correlation between the Fed balance sheet level and the level of the S&P 500 and in particular the NASDAQ. And so what people are saying is that with liquidity drying up, the stock markets are suffering. Yeah. Back to your original point, will the Federal Reserve reinvigorate QE anytime soon?
I just can't see it, not until we see those inflation numbers come down. And again, I think you're in a special case now where you will see that inflation number stay elevated for multiple years. And so again, it's not to say that we're going to go necessarily 60% lower in the S&P, but I think you have to think that there's quite a bit of downside here in the next 12 to 18 months in the S&P.
All right, let's move on to cryptos and Bitcoin. I see there's 1,600 people joining us now. So that's 60% more than 10 minutes ago. Good job, guys. Spread the word. Get more people on. Get all your crypto friends on to watch the show. We are talking about Bitcoin now. And don't forget to subscribe to YouTube. Gareth, your Bitcoin call has been successful, to say the least. Back when you were, I remember this very well, September 2021, peak of the crypto bull market. Everybody was hyped. Everybody was excited for what's to come. And I remember having this conversation with you, and you said that now is probably not the best time to be getting back in again because the levels just look a little bit overstretched. If you look at the technicals, it's repeating what happened in 2017. And if you, I'll let you show the charts. And I remember you telling me that this charade is not going to last forever. Let's just revisit that call one more time, please, before we get into your next Bitcoin bottom. We are going to answer the question, what is Bitcoin going to do next and what is the next bottom? So stay tuned for that answer. But Gareth, tell us about why you made that call. Why did you think back then in 2021 was everything was going up, everything was hyped, institutional money was going in, you were a contrarian and you thought that Bitcoin was going to drop 70% down to 20K?
Yeah, so it basically was everything you just mentioned, right? It said in general, as a psychological trader, and part of trading is understanding human emotion and understanding that when the whole crowd, when every single person is rushing into an asset, that's usually the mark of a top. And you saw this, we saw this in 2007 with the housing market when Time Magazine featured like the home flipper on their front page. It's exactly the same thing. When you have the mom and pop saying, hey, this is so easy, I can't believe how much money I'm making, it's usually the end of the move. And then you look at the charts and you understand the massive move that has gone on, the double top that we saw in Bitcoin, all the factors out there. To me, it was one of those no-brainer scenarios. Plus, let's not forget that by November, when Bitcoin was topping, we knew the Fed was going to start raising rates, right? We already saw inflation spiking, and everyone was saying, oh, listen, inflation's spiking, so Bitcoin has to go higher. But the essence of it is inflation spiking. Bitcoin was already factoring that in. Now it had to factor in the major tightening that the Fed was going to bring in. And remember, there was so much money that had been thrown into the Bitcoin market, from checks going to Americans from the government, from quantitative easing, from all the stimulus. People were home. They weren't driving to work, so they were saving on gas money. They weren't taking vacations, so they had extra money. So all that money was going into crypto or stocks. Now, all of a sudden, you get to a point where the Fed starts sucking out that liquidity, and there's really no other way for any assets to continue up, and we've seen that here. Okay, so what we're seeing now is a very different environment than last year. None of what you just described, which was happening last year, is currently happening now, and yet we're not seeing a dramatic collapse of the Bitcoin price from, let's say, 6 months ago. You would recall that Bitcoin has been dropping steadily and dramatically in the first half of the year. But, it's ironic to me that even following the collapse of Celsius, even following the collapse of FTX, which happened in the last month, Bitcoin didn't tumble to another 50% from its June highs, for example. Right. That's very interesting to me, how things on the macro picture seem to be getting worse, yet the price is holding steady. Yeah, so as bearish as I was when we were at 65 to 69,000, I would say I'm lukewarm now on Bitcoin.
Okay.
It doesn't mean I think the bottom is in, but you're right. Let's take a look at the chart of Bitcoin. This is something I want to show you guys.
Yeah.
So here we have, this is the drop on the Terra Luna collapse. And we dropped from about 31,000 and change down to about 17 and change. And so that drop was about 40+%. Now, if you look at the collapse of FTX, Bitcoin only dropped 25%. And so you could argue that FTX was a much bigger blow up in terms of institutional money being involved and kind of the earthquake that it caused, yet Bitcoin dropped less. And so to me, I take that as a signal that says, okay, it's not the end yet, but we're getting there. And so a couple of the analysis points. So number one, I looked at the comparisons of FTX's blow up and the Lehman Brothers collapse in '08, noticing again, Lehman was a bank. It collapsed. An exchange, FTX, kind of like a bank, but in crypto, it collapsed. Now, how long did the S&P 500 take to bottom after Lehman Brothers? And the answer is it took about 6 months. So then extrapolate that out and say, okay, in 6 months from now, we might be seeing the bottom in Bitcoin. And the reason you can kind of extrapolate this out is because human emotion, you could say, oh, well, that's stocks, this is crypto. But the answer is it's all the same. And the reason it's the same is because humans, you and me, we're the buyers and sellers. And does your emotion change? Does my emotion change? No, greed and fear. It's what rules the market. So you can really extrapolate that out. And the last thing I'll say is, the S&P, when Lehman collapsed, fell another 45% from that point, from that collapse, before it bottomed in March '09. In that case, we should see Bitcoin fall approximately 45% more from approximately that, breakdown level around 18,000 and change. To me, that gives me a target just below 10,000. And keep in mind that max pain is caused when even numbers are broken. You'll see a ton of stops run at 10,000. That could be the bottom when it breaks into the 9,000.
Just real quick about, is that psychological?
Yeah.
Okay.
Yes, it's
not
and again, the three
thing.
factors, always remember, an investor has three factors to them. Number one is personal discipline. So you have to be a disciplined investor.
Yes.
Number two is human psychology.
Yes.
And that's this part where charts will match up. History repeats generally, or at least rhymes, because of the human emotion and the human psychology. And the last is understanding how to read that through the charts.
Mm-hmm. Yeah, we talked about that. We did an entire segment
That's right.
on the psychology of trading, an hour-long interview. Well, maybe we'll put the link to that video in the description down below in the playback. But Gareth, going back to the Bitcoin price, it's interesting also to note that Bitcoin has historically, in the last 2 years or so, been very much correlated with the NASDAQ. Mm-hmm. And just in the last 6 months or so, that correlation hasn't been very steady, shall we say. The NASDAQ has continued to fall while Bitcoin has been trading range-bound. For the exception of the Luna collapse and the FTX collapse, those were anomalies, right? But more or less, it's been trading range-bound. Some analysts have even gone as far as to say that Bitcoin has been correlated to gold. And if you just look at the charts, that does seem to be the case. Now, is that correlation a coincidence, or is there something more underneath the hood?
I think Bitcoin is starting to get into that mode of being between the two, right? So I think what you're going to see, and this goes with the predictions, right, for 2023, where the NASDAQ and the S&P are going to continue down. But what I'm saying is Bitcoin's going to actually bottom out and actually start to turn up in 2023. So that means it has to decouple from risk assets. And the key to this is going to be regulation. As much as everyone hated the idea of regulation in crypto, now we see an FTX scenario and everyone's saying, all right, well, you need some transparency. You need audits. You need to see the books on these players. There has to be rules where they can't take customer funds and put it in other places. And I think that's going to be the key that really starts to trigger Bitcoin's next move up, is when you get regulation, institutions will finally start to come back to invest in Bitcoin.
Okay. And no one knows exactly when this saga will, will escalate to regulatory frameworks being set en masse around the world. Although that is, there does seem to be progress on that front, Gareth.
And remember this, right? Before it wasn't popular with people, now people have been burned so much that it's popular. That means the politicians will act.
People only want regulation when everyone's burned.
That's right.
Yeah, 2021, nobody wanted any regulation.
Going up.
Government, stay away, please, leave us alone. Okay, well, that's how it works, I guess. We have almost 2,000 concurrent viewers. We're about to take questions very soon, so get your friends to log on to this stream. and submit your questions. I want to talk about a few stocks and then oil, and then we'll move on to the Q&A. So a few popular stocks that you're eyeing: Apple and Tesla, big names in the tech sector, big names in any index because they're just huge market cap wise. You initiated a short Tesla position a while ago, didn't you? Tell us about that.
That was when it was trading at the all-time highs, actually. I still remember coming on there, and I was in earlier than that, and I was feeling a little bit of pain when we were at the highs, and everyone was kind of, by the way, the same emotion that you saw when Bitcoin was at its all-time highs was there in Tesla at that time. And since then, we've seen Tesla down more than 50% now. So again, I'm no longer in that short. I don't usually hold after something's fallen so much because the risk reward is no longer there. But it's certainly, that was an amazing fall. But again, if you're a trader or an investor, you have to start paying attention to the psychological signals that the market gives off. When everyone loves something, be skeptical.
When everyone loves something, be skeptical.
Yeah.
Is that personal advice as well, Gareth?
I'm not going to cross that level there.
Everyone still loves Tesla, though. It's still a stock that people love. It appeals to a fan base of people who just love Elon for one reason or another, whether or not you hate him or love him. He is influential. He just bought Twitter. We'll talk briefly about Twitter. Tesla is an emotional stock.
Yep.
And just because the charts are down, one could argue it doesn't deter the stock from rebounding to its true all-time high potential.
Yeah, I think that's to some extent true, but again, you have to think that at some point valuation does matter. And if Tesla's sales start to drop more and more, there are big institutions that own this that probably way surpass the retail investor. And so you have to think that at some point it continues to come down. In fact, I do have it priced to come in at least down to $135, $140 per share, which again, it's at 180 right now. It's not a huge drop. But keep in mind, if we go into a recession, like I'm saying, how many people are buying, the highest priced electric vehicles?
I'm just waiting for the day that we can start buying Tesla vehicles with Dogecoin. And then Tesla becomes a half vehicle manufacturer and half hedge fund for Bitcoin and Dogecoin.
I love it.
And then that would be that would be great. No, I'm kidding, of course. We don't really want that to see that. I want to talk about Apple now. Apple, big earnings season happening in Apple, and there's big news coming out of China. Foxconn, the company running the manufacturing of the chips, has factories in China. There's been I don't know if you follow the story, but there's been protests happening in the Chinese factories because of the zero COVID policies. The violent protests, actually. Workers were storming the security guards and refusing to work. I think people were offering them, the company has offered them $69 bonuses to return to work, which I guess for them is a lot of money.
Yeah.
And, and it's just a sad environment what's going on there, but that has delayed production of the iPhone 14, and the company is not able to meet demand right now. So it's going through a bit of a tough time.
Yeah, it is, absolutely. And I even think further tough times are coming if you do see that recession come in 2023.
Yeah.
I still think the valuation, if you go back to the olden days, in markets, the blue chip stocks, there was a valuation that was given around 10 times PE, right? 10 PE on some of these stocks. Apple's still trading in the mid-20s. And that to me is way too pricey, especially if I think we saw their App Store actually kind of miss on their revenue numbers in their recent quarterly statement. And that was kind of their growth engine. So I do think that, again, there's more downside. In fact, if we go to the chart, one of the things, if you want to follow when the next leg down is going to start in the markets as well as in Apple, and I connect those dots on purpose because Apple is such a big market cap, there's a trend line that connects all these lows going back to 2020. And when that line breaks, it's around 136. That's when that next big fall will happen. Right now, we're trading at 144.
I do want to move on to the Q&A in more detail later, but this question has been recurring. Santa Claus rally. It's an actual thing that's happened before during Christmas time. Is that going to happen again?
Honestly, I'm not 100% sure. And the reason I say that is because when everyone expects something, oftentimes it doesn't happen, and I feel like everyone is expecting it. So for me, I never trade that type of thing.
I don't know if they're expecting it or just hopeful. I think hopeful is a better word to describe
I know,
the
I agree with you on that.
Yeah.
So I think for me, it's one of those things so I've always learned is that anytime you're like, oh, in the past years, this has worked.
Yeah.
Every time I've used that mentality to invest, I always lose.
Okay.
It's almost like the market just cons you into doing that. And so, it may happen, it may not. I want to look for the sound charts, the good setups, and take those.
Well, do the setups and the charts indicate any sort of technical bounce in the near term?
So this is the problem with the S&P 500. We'll look at the spiders real quick, is that you basically have a trend line. Look at these trend lines here. So you have the all-time high trend line from here to here to here and to here. Yeah. And we fell right off of that. And then you had this gap fill. But let's even take away that line for now. Just look at it even simpler here. Okay? And again, I'm having some issues taking that away. That's okay. But now look at the upsloping trend line on the spiders right here. And look, we've now broken below it. And this is what we call a bear flag starting to form. So as long as we stay below this area here and we don't break out above that high, that all-time high trend line, I think you got to be bearish into year end and in January of 2023.
Interesting. Okay. Well, that's, I was hoping for better Christmas news coming out of you, but that's okay. No, that's...
But you know what? There's always... So this is always remember, everyone. I always remember that in big bear markets, that's where the next billionaires and millionaires are made. It's not buying Bitcoin at 65,000 and then watching it flush. It's when do you have the guts to step up in a bear market?
Here's a question for you, and this is kind of an age-old question, but it pertains to timing of the markets. Would you rather buy an iPhone 14 right now or spend that money buying an Apple stock?
Wow. I'm not
right now.
I'm not a huge Apple person, so I'm going to go with the stock.
Okay, that's not the answer.
Here you go. How about, can we change it up and say,
Samsung?
I think you take that money and you put it in Bitcoin. Yeah, it's going to go lower, but I think in 10 years, that's worth 10 iPhones.
Really?
Yeah.
Okay. Yeah. Well, you have to have personal discipline to hold it, though. This is a separate conversation, but I just want to touch on that. People have said to me, well, if I had bought Bitcoin 10 years ago, I'd be a millionaire. Would you have really, though? Because you would have sold before then, hey?
Yeah, for me, for sure.
Yeah, I mean, most people have said if I bought Bitcoin 10 years ago, I'd be, XYZ rich, but...
Well, always remember, I never buy the exact lows and I never sell the exact highs.
Right.
I just need to get close, and if you do that consistently, you make millions.
Right, of course. And we do want to talk about, personal discipline in another segment. But right now, let's come back to oil. Mm-hmm. That's another sector and asset class that you follow. And you have correctly called the top in oil when even above $100 a barrel. I was talking to you, and you said that it's probably going to go to 120, 130 before it retraces. And lo and behold, that's exactly what it did. And it's come back down. Gareth, it's been coming down for quite a number of months now.
Yeah.
What's next?
Yeah, so unfortunately, it's going to go lower. There will be a key level at around $65.50 for a technical bounce. So for those of you out there thinking about a swing trade, that would be where I'm going to be looking for it, right around 65.5. I want to just show you this because I think this is such an important example of education and understanding market psychology, is that if you look at the charts were very clearly showing us that when we hit $130 a barrel, which was over here on my chart, that was going to be a high. And I'm going to show you why. So essentially, we take a parallel here, we drag it over here. Well, and bear with me as I got to get that correct. So essentially, we drag it right through there. And you could see again how on this chart, if you connected the low in 09, the low here in 16, and the dip here, you got the exact high of 130, which was when Russia invaded Ukraine. And the thing is, everyone was saying, everyone, including analysts on TV all across, oh, oil's going to 200. But if you just thought about it logically, you had central banks across the world hiking interest rates. And when they're doing that, what are they doing? It's slowing the global economy.
Yeah.
So again, you take the oil that Russia produces even off the market. We know it didn't end up off the market, but that's not even close to the lack of demand or the demand destruction that we were seeing from all these rate hikes. And people have to understand that.
Let me give you a counter argument to this. We've seen the embargo on Russian oil really bring down production, at least expectations for production. It didn't have as dramatic of an impact as some analysts have speculated. Now, the counter argument is that China, which is about to release or relax its zero COVID policy in the near term, we're about to see a huge influx of Chinese oil demand, and that's going to push up prices. What do you think? So
I do think that will help put in a little bit of a low, and my guess is that could coincide with the technical level of around that 65.5 level. And I'll just show on my chart real quick here where I'm getting this level from. Again, you basically just drag this trend line across, and you can see going back to 2019, these pivot highs coordinate with these lows, and it's right around that 65.5 level. So on a technical basis, it looks like we could get there as early as next week. And then I think you do see a bounce as you see this reopening kind of trade in China.
All right. I do want to move on to the Q&A now because I promised the audience about 30 minutes in. We move on to the Q&A. We've seen a lot of good questions come in. Let's see if we can get up to 3,000 concurrent streamers. We've got 2,050 right now.
We got
get up to 3,000. Gareth will reveal his top 2023 assets, so you don't want to miss that. All right, folks, let's start with the questions. Recurring question on gold outlook. Gold intermediate and long-term price target. Let's do gold.
All right, so intermediate price target. Number one, we've seen gold come off of the lows. As soon as the Fed showed any sort of dovishness, that's when gold bottomed, right? They didn't have to cut rates. They didn't have to do anything like that. They just had to show that they weren't going to keep hiking by 75 basis points. Gold has surged up. It's hitting some resistance right here at around 1,800. I think in the short term, it's going to break through there, and I think you'll head up to about 1,900 and change. In 2023, you should surpass the previous all-time high of around $2,070. And I actually think you have a good shot of making a move towards 2,500 in 2023.
Okay, well, you were telling me about how inflation is going to be sticky but come down a little bit from current levels. You were saying how the Fed will continue to raise rates, albeit a bit slower, and perhaps that may strengthen the dollar some more. Correct me if I'm wrong, Gareth, I just don't see any tailwinds for gold.
Yeah, so the tailwinds are that the Fed does a 50 next week, then a 25 in January, February, right?
Okay.
And then they're done. They're going to have to step aside. You're going to see the jobs market start to really deteriorate. We know it's a lagging indicator. I think you even got the jobless claims just yesterday coming in a little bit higher than expectations, meaning more people filing for unemployment. So the tailwind is right there. And then the secondary tailwind is where are you going to put your money? Let's say we do go into a U.S. recession and stocks go into a prolonged bear market.
Yeah.
Where else are you putting your money? Where do you protect your money with elevated inflation, no Fed rate hikes, and a stock market that the earnings per share continue to drop for stocks?
I'm just going to push back slightly because this is a counter argument that some skeptics of gold have given me this year in my interviews. People have said the exact same thing last year. Where do we put our money in light of higher inflation and a deteriorating economy, both of which we had this year? Well, if I had put my money in cash, I would have beaten everything, including gold this year.
Including gold.
I mean, yeah, so
no, you're right about that. You're right, absolutely. And I think you have to look at what the dollar did. The dollar was incredible. If you look at the run in the dollar, so the dollar rallied 20%. Gold only at the lowest point was down about 7% on the year, I believe. So it showed relative strength. But again, watch out for gold. And I will say that it's going to be a great performer.
Gold miners, do you like the gold miners then?
I do. Again, they're more volatile, obviously. Yeah. But the key is with the gold miners is you really need to see inflation subside because their input costs, especially if gold goes up significantly, that's great for them, but they are paying their employees more, they're paying more for their equipment. And that's why early in the year they underperformed gold so much is because of those input costs. Their earnings were far, far less.
Silver's had a great month, I think, on the back of a stronger gold price. Right?
Yes.
Or was there something else that pushed up silver as well?
Yes, so I think the weakness in the dollar, right? And so all the same factors. And I think, again, the idea here is silver can also be a positive with the China reopening. So you have the aspects that we just covered on gold plus the reopening of China can add to the gold silver pressure.
We're going to jump around asset classes in no particular order, just as the questions come in. This one's a good question from Mr. Rulu on Twitter. Hi, what happens to Bitcoin, BTC, if USDT Tether collapses?
That's a good question.
Yeah.
And so I think this really broaches into something else, which is the CBDC, right? And I think if you look at a central bank digital currency, that could be now an issue for some of these stable coins. All right. So again, stable coins, there's no scarcity to them. They're basically just pegged to the US dollar. You get a CBDC where it becomes just as fast to move currency around, and then that could be an issue. Now, I think that Bitcoin will ultimately kind of surpass everything and be fine. But again, it doesn't mean there won't be some rocky roads there for sure.
Okay. What about the notion that CBDCs may actually incentivize more people to look into the crypto space and educate those people who are currently not in the crypto space right now about blockchain, and then they will start buying Bitcoin and push up the price? Is that an argument you buy?
Yeah, no, I do, absolutely. Anytime you can get into any digital currencies, it's going to make people explore more of the digital currencies. And I think that's 100% right. It's a great thing for the crypto sector. I still think, again, most cryptos won't survive when we get out of this period, but you'll see the top 20, 25 at least survive and thrive.
Okay. Here's another question from Rahul Power. Amazon stock target. Do you have any, we were talking about Amazon. Do you have one of the largest tech retail companies in the world?
Yeah, so I would say in 2023, I'm looking at $65 as a target. That's about a it's about a $25 drop from here. So there's going to be more downside. It is at support. Amazon is absolutely currently at support. But I do think, again, as the markets deteriorate, you're going to see big players like Amazon go lower. And that has to do with consumer spending, right? People are going to feel poor. Their home prices are going down. Their savings, their 401ks are dropping. And you will see that consumer spending kind of come back in.
Mm-hmm. I guess this kind of teases your 2023 best asset outlook. But anyway, this is a question from Mr. Roundel. Does Gareth believe that the trend of money being diverted from gold towards crypto will be reversed over the next year? Or maybe the burned speculators will avoid all asset classes?
So I don't think that you'll see necessarily it reverse. I think that as the stock market in the U.S., which has taken in more money than any stock market globally, any asset class globally in the past, really 13 years since 2009, as you start to see less returns being generated, money will have to go towards other markets, including gold, including Bitcoin, once you get regulation in Bitcoin. So I think that there's plenty of money there in a prolonged bear period for gold to thrive and Bitcoin to thrive.
Mm-hmm. What's the best sectors to be in if we are in a 2023 recession? This is a question from Joey Socks.
Oh, wow. Best sectors. So I think you want to look towards the metals, right? I think the metals are definitely a place where you can hide a little bit, including the physical. And then I think for the most part, you want to steer clear of tech. And again, this is a tricky one. I'm a swing trader, so I'm in and out quite a bit. If you're not a swing trader, honestly, look towards foreign markets at this point. Look towards, I continue to like the chart on Brazil. The Brazil EWZ is the ETF that tracks the Brazilian stock market. I think China's had a huge run recently. If that can pull back, that becomes very, very attractive as well.
Okay. We haven't talked much about the altcoin space, but this question came in a few times. Do you think altcoins will outperform BTC next year?
Wow. I think that
Let's just define altcoins because people have different definitions. Strictly speaking, an altcoin is anything that is not Bitcoin.
Bitcoin, right.
But let's take out Ethereum because that's also big. So anything besides Ethereum will outperform Bitcoin.
I think if it survives, yes. And I think investors have to really think about what they're investing in because remember, we don't even know what what's a security, what's a commodity. If it's a security, which is basically almost anything but Bitcoin, what are the rules that are going to be applied? What's the level of entry? Remember, to be listed on the NASDAQ, it costs a lot of money. So I have a feeling that there's going to be costs like levels to entry. And there's going to be a lot of coins that can't handle that, including the transparency side.
Yeah.
And we don't know this. And again, you go through something like Terra Luna, you go through something like FTX. As an investor, those were mega market cap cryptos. You have to be really careful, and I'm sure there are more, things to fall here.
Last year in Dubai in October 2021, when Bitcoin was still edging towards that $69,000, you and I were talking about the Bitcoin spot ETF. That was all the hype back then. What happened to that?
So, it's still a way to trade. I just don't like it because you have slippage as the contracts roll over. So I really hope that they do come out with a real ETF. I think that would open and be a huge bull factor for Bitcoin. Don't expect it before regulation. But yeah, I think that I still remember that vividly because we talked about how in 2017, they launched the futures, right? Mm-hmm. So they launched the futures when Bitcoin was at its all-time highs. And then here, and when Bitcoin was at its all-time highs, they launched the spot ETF or the ETF. The futures ETF.
Right.
Yeah.
Spot ETF, still haven't seen that yet.
Come yet, yes.
Derivatives, yes, but not the spot. I wonder if that's going to change anything right now with all these crypto exchanges and firms and collapsing and contagion spreading throughout the sector. If another big exchange collapses, we're probably done.
Yeah, it's possible. It's possible. I don't think that Bitcoin will be done. I think there's inherent need for someone or something to be there that we can invest in or at least store our money in. But I do think that other cryptocurrencies are going to struggle.
Light Shadows says, Gareth is the oracle of crypto. And then he says, please reveal your top 5 crypto picks for the next bull market.
Well, so for the next bull market, the only ones I feel mentioning are Bitcoin and Ethereum. So I'll stick with 2 right now.
Okay. All right.
Because you know, if I say anything else, and it'll come back to haunt me. There'll be a clip.
Well, your Bitcoin call certainly didn't come back to haunt you. In fact, it's been a claim to fame.
Yeah.
All right. Body and Barks. This is creative usernames, guys. Keep that up. Body and Barks. Should we be worried about Bitcoin price if and when a CBDC is implemented? We touched on this briefly.
Yeah, so I don't think it's a competitor to Bitcoin. I think it's a competitor to
and I think they mean a Fed coin, because we have currently 8 countries around the world that have CBDCs already. Most of them are in the Caribbean, oddly enough. But yeah, a CBDC be implemented here in the West.
Yeah, so I don't think it's an issue for Bitcoin. I think that, again, anything the central bank produces, they're going to have their finger on the printing button, just like they do with fiat currencies. And it's just going to be like, okay, well, do we need more? Well, let's print more. Now let's take some away. And so it doesn't solve any of the issues that Bitcoin potentially solves as the digital gold, right? That scarcity aspect. So if I'm looking at that, I'm more concerned about the stable coins and how does that fluctuate with them? How do they handle that?
Mm-hmm. It's a question from Onion Farmer. Onion Farmer wants to know if there are any ways to hedge a market collapse. In other words, should the S&P 500 fall, and should Bitcoin continue to fall, besides gold, what other assets within the risk asset side could possibly see an inverse correlation with stocks and Bitcoin? I know you're bullish on gold, so let's just strip that out of the equation. Yeah.
That's a good question. I don't have a whole lot in terms of answers at this point. I think you start looking at certain technologies. I know we were going to mention Meta at some point, but I think you have to start focusing on companies that have been hated on, that have been beaten down by X percentage, and that actually could be developing something that could be huge. And again, just like when everyone loves something, I usually don't. When everyone hates on something and it's a good quality name, I usually start to get interested.
All right. Well, speaking of interest, there's a lot of interest on whether or not assets will bottom before a Fed pivot. So you talked about a Fed pivot. Well, to be clear, let's define a Fed pivot.
Right.
What is a Fed pivot by your definition? Is it just the halting of interest rate hikes, or is it a complete reversal of policy such that they would have to cut rates?
I think in general a pivot would be pivoting back down and cutting rates. So I think initially what we're seeing now is them just backing down a little bit. And even when they're not raising anymore, that wouldn't be the pivot yet. I don't think that I think even when the Fed cuts rates, the market could be in such poor shape. And by the way, I think it's going to be well over a year before the Fed cuts rates. Let's be fair on that. Even in a recession that gets ugly, I think you're going to see a long period of time before the Fed has the guts to do it. Because remember, the Fed was all about transitory. They really got egg on their face in that situation. And they're going to be very careful about creating that same inflationary pressure, right? And if you think about it, right, who benefited the most from asset prices going up? Well, the wealthy. And who got hurt the most from inflation? The poor. And so I think there's this big kind of thing about they don't want to be viewed as the ones that are catering to the rich. And so they're going to be very careful with inflation. Okay.
Is silver a good inflation hedge? There's a lot of questions on silver, so let's just ease into that topic.
It is. You have to, if you're a silver investor, you have to be aware that silver is also an industrial metal. So if we went into some sort of global, real bad recession, there might be some sort of demand destruction there. But at the same time, we know that there's a lot of new technology stuff coming out, electric vehicles and so forth, that use silver. So I would say this is that the pure play is gold, but I do like silver, and I think silver, again, will do fine, very, very well.
Rahul Power asks silver price prediction. So give us a price target.
So I think for me on silver, we're looking at probably a move in 2023 to, let me just take a look here on my chart. I'm looking at probably at least up to 28. Hard to know if we'll get above that, but I think $28 would be a pretty easy target. Maybe even testing $30, which again would be that recent high.
This is a good question. Again, we're jumping back and forth now. I'm just reading questions as they come in, the good ones now. Price prediction on the day of Bitcoin halving early 2024. This one came in from Lewis M. We haven't talked about the halving very much, you and I. And it's true that if you looked at previous halving cycles, Bitcoin has historically rallied in the 6 months following the halving event. And people have looked at that as a consistent indicator of another bull run. Is that really that easy? You just put it on your calendar, it's going to have, and then buy Bitcoin?
It's not quite as easy as that. I think there's a lot more that goes into it.
Right.
But what you'll see is if I'm correct that we bottom sometime around May of 2023, that almost puts us just a little over 6 months out from that event. And I think that would just be a positive. But for me at this stage, the only thing that matters for crypto is regulation. And again, you got to get that in there because again, you could be the biggest fan of Bitcoin. If institutional money doesn't come near it, it's never going to 100 or 200 or 500,000.
Question came in from Japanese Whiskey. Japanese Whiskey wants to know, Gareth, if the next Bitcoin cycle, bull cycle rather, we're talking about 9K price target, but the bull cycle, is that going to be as dramatic and significant as the prior bull cycles? Keep in mind that in every single prior bull cycle, you've seen a decrease in magnitude relative to the previous bull cycle. Percentage-wise, Bitcoin has rallied less and less in each bull cycle as, I guess, the asset class matures.
And that's exactly what it is. It's the maturity of it. So I think what you can do is you can extrapolate that out. Look at the 2013 or 12 bull market, the 2017, and obviously the 2021. And you can look and see what those percentages were. And it probably will decrease. That would be a great way to figure out the potential target for it to go to.
Okay. Stellian BTC bottom. Okay, no, that's a question from the guy named Stellian BTC. Bottom is at 9K, or can we go back into the 6 to 9K channel and stay there for years? You did say to me in Dubai that the worst case scenario, I believe, is 2.5K.
Yeah.
You said that to me 2 months ago.
Yeah, so that's your worst case, and you still have to keep that. As a trader, it's so important for us to not only look at our best case scenarios, but our worst case. What if we're wrong? How do we maneuver? How do we trade around our positions? And in essence, is if this was really the .com collapse, and let's say Bitcoin is the Amazon.com of the crypto markets. Right. Amazon dropped 95%, which puts you back at 3,500, which happens to be the pivot low support from the last cycle low.
Okay. We've been running for an hour now. We'll go for a few more minutes. I know we'll let people go watch the World Cup. But tune in, and we will reveal Gareth's top asset class of 2023 towards the end of this stream. Get your friends to submit questions. We've got a few minutes left, so write down your thoughts if you haven't already. Let's move on now, Gareth. Let's move on to this question from Raid Reba. Do you consider that there is a potential upside of $250 to $300 per ounce in gold in 2023? You've kind of touched on that already.
Yeah.
But $300 from here is a lot.
Yeah, 300 from here kind of gets us back towards that double top or just above it. So yeah, I think that's absolutely the likely scenario. In fact, I think we actually go higher than that.
Okay. Does that mean a lot of weakness for the US dollar then?
Yeah, I do think the dollar starts to come in. I don't think you're going to see a ton of weakness initially. It's not like the dollar is going to collapse, but I do think the dollar has actually put in its high recently and is now on a downward trend. So I think it'll take some time. I think the biggest drivers for gold will be a slightly weakening dollar and then the economic struggles that will hurt the stocks and the stock market valuation.
Okay. Would Ethereum's price collapse if it was ever officially classed as a security?
Yeah, I think it all depends on what reporting requirements there are. And I don't think that Gary Gensler is looking to really destroy Ethereum. There's so much built on Ethereum. I look at Ethereum and I kind of look at it and say, okay, Ethereum is like Apple or Microsoft. It has these firm foundations. There's value there. And I think if it's treated like a security, it's probably valued at least at what it's valued right now. We just have to see what those reporting requirements are. So I'm not too worried about that, believe it or not. I'd be more worried again for the tiny coins out there that are kind of just brand new with little to no use case. I think those are going to be kind of washed away.
Yeah, well, certainly most of these tiny coins have been wiped out, if not suffering greatly already.
Yeah.
The issue of the metaverse is something that transcends not just tech stocks, but also the crypto landscape as well. A lot of crypto blockchain projects are being built around the concept of a metaverse. Let's talk about that a little bit. We don't have to drill into specific companies, but the biggest one that I can think of, obviously, is Meta, previously called Facebook. They're building their entire brand identity around the metaverse. How is this technology going to affect investments?
So I think it's the new frontier, right? I mean, it's definitely that and space travel. So you have the kind of the inward being in your own world, and then you have this outworld type of thing. And so I think Meta's doing the right thing. I know it wasn't popular with investors and the stock got punished because of it, but I think that Zuckerberg is smart enough to realize that his future product of Facebook and Instagram will slowly lose, the people. People are getting more and more fed up with social media, I think, and there has to be something new. And he's trying to get to that. He's trying to be the number one there. And I think he'll succeed. I mean, if we can't really doubt him, he hasn't given us any reason to doubt just yet. So I'm a fan. I think if there's one stock that I would feel comfortable, and I would still want to pull back, right, on Meta, but I think $100 on Meta gets me in on the long side, even in a bear market.
Mm-hmm. All right. Are there any other stocks you're looking at that have bullish potential over the next year, Gareth? Individual stocks?
Not off the top of my head, to be honest. I would just say, again, market-wise, for the next year, I continue to like the Brazilian stock market. I think that's a really interesting chart setup. And again, what's amazing about the Brazilian stock market is the last time I believe it made an all-time high was let me go on my chart here and scroll out, but I believe it was in 2008. So again, if you look at the U.S. markets and how 2008 is a distant memory, we're so far beyond that it's not even funny, but the Brazilian market made a high and it still hasn't even gotten close to being back there. And so look for money to rotate into other areas of the globe that it hasn't been in, and you'll see, I think, that one do very, very well in 2023.
Mm-hmm. All right. This is an interesting question. It's kind of a challenge to your thesis. Is there a scenario, I guess hypothetically speaking, is there a scenario whereby your bearish stance doesn't work out and the bottom is already in? Thanks, Gareth.
So there's always scenarios, right? I mean, that's the one thing of being an investor. You have to always be ready to be wrong. I've certainly been wrong before and I'll be wrong again. It would be shocking, but if the Fed for some reason all of a sudden said, hey, listen, screw inflation, we're going to start printing money again, we're going right back up. Now, it would eventually lead to the biggest, even a worse collapse. But yeah, I mean, that would be the one scenario.
Wait a minute. You're saying that should the Federal Reserve resume QE, a collapse is inevitable either way?
Yeah, eventually, right? I mean, you blow a balloon up, you can keep blowing it bigger and bigger. Eventually it pops, right?
Well, yeah. Well, this would be a pretty big, strong, elastic balloon now. Yeah. Okay. Well, I do want to touch on oil a little bit more. People are talking about that. You and I have discussed this offline, actually, about how oil has been correlated with the CPI index over the last 6 months or so. And actually more than that. Over the last year, you can notice a pretty consistent correlation. I wonder if one leads another or it's just coincidental.
No, it definitely has a coordinated effect on each other, right? The key is understanding is that oil is just one component, but it is one of the major components. So, when we saw oil early in the year at $130 a barrel when Russia invaded Ukraine, there was no doubt that the CPI data was going to be very, very hot for the next few months on that. Now we've seen it come back in and the CPI data should continue to come back in.
All right. We are getting even more concurrent viewers. For those of you watching who are new, please don't forget to subscribe, because otherwise, how are you going to be notified when Gareth comes on next?
Yeah, that's right.
You don't want to miss out on his next big announcement. Yeah, the metaverse is glorified video game. This is from Joey Socks. Okay, Joey Socks. I've played video games. That is. I would say the video games are glorified metaverses, other way around.
Yeah. I think that's fair.
Yeah, we've had metaverses for more than 15 years already, just on the desktop computer.
That's true.
You have a gaming chair actually that you stream from at home.
That's
I don't know if you play any video games yourself.
I unfortunately don't have much time, but I did get that drone, and now you and I are gonna have a session where we fly our drones together. Huh?
Yeah, that's true. Yeah,
we should stream that.
You mentioned space as the next frontier of investing. Is that something that is investable?
Not yet. I mean, again, it's something that's on the horizon, but literally. But it definitely is something that in the next 5 years, I think you want to keep an eye on. And by the way, I mean, they're going to be eventually mining asteroids for metals and rare earth and all that stuff. I mean, there's definitely going to be that.
We will. Well, I said 3,000 concurrent streamers will reveal the big reveal. We're close enough. We'll do it towards the end anyway. But Colin Farrell, I don't know if this is the real Colin Farrell, but somebody named.
I think it is.
All right, Colin Farrell, thank you for watching. Get more of your celebrity friends on the stream. He says, is there a scenario where gold flies and miners drop? That's a great question.
I don't think so. Not a total inverse relationship. right? So if gold flies
well,
up...
let me propose this to you now. Suppose the equities drop, like you said it would. Wouldn't that bring down the miners, even if gold holds steady?
So if gold holds steady, yes. But I mean, if it flies, I mean, let's say gold goes to $3,000 an ounce or even 2,500, I would be hard pressed to say that, okay, gold is there, but miners are down 20% on the year.
So hypothetically speaking,
they could underperform. I think that would be the best.
S&P goes down 40% next year. Gold goes up to 3,000. What happens to the miners in that scenario?
Miners are probably up around 20% or so.
See. Okay,
yeah.
so it's kind of a balancing gap, but still follows
They'll lag
gold
a little
more.
bit.
All right. Now, let's come up with a few more questions. We have a question about the Federal Reserve. Should the Federal Reserve pivot sooner rather than later? What's going to happen to the markets?
So my guess is they already overstepped on the hikes, and I think the Fed falls into that same category of being humans. They saw their mistake with saying transitory. Now they felt like they had to pound their chest and kind of reverse. They overdid it the other way. This is a history of the Fed, by the way. They always do this. They kind of overshoot each direction. So I think at this stage, they're going to be very reluctant after being burned on the transitory side to then go back to printing. And I think they'll err on the side of caution. We know that in the 70s and 80s, this was an issue. They started to reduce rates too quickly and then inflation took off again. And I think Jerome Powell has said very clearly that that's an issue. And I think you have to look at, the fact of who gets hurt with inflation versus who gets hurt with higher asset prices or who benefits. And so I would be very shocked if it'll be in 2024 before they lower interest rates, in my opinion.
Okay, this is a question from Jeannie. Jeannie wants to know, when does Bitcoin go to $100,000? We've talked about your 9K downside. When does it go back up to not just its previous all-time high of 69, but let's hit that round number of 100K.
I think you're looking at 2028.
2028. And that's, I guess, after the recession's over. That's, I guess, after the Federal Reserve has already loosened policy, right?
Yeah, and I think it's also that establishment where you have the regulation, people start seeing that, okay, it is a real asset. You have more and more people adopting it in terms of a place to store their money in terms of not in fiat currencies. I think all of that takes time, but it all starts with that regulation.
When does the recession end, Gareth?
Man. Where's my crystal ball?
Yeah, it's over there. Can we grab Gareth's crystal ball, please? He needs it for this question.
Yeah. I think we're in at least a recession for the next 3 years. And I think it starts in 2023. I don't know if it'll start in the first half of 2023, but
nobody knows when.
Yeah, this is just, again,
but we want to hear your rationale.
Yeah, my rationale is that, again, the market is going to have to pay the piper in that we have always, for now, in recent history. In fact, there are so many investors in the market that have never known a true market. It's always been a market that has been bailed out by the Federal Reserve. You take that gentle holding hand away, and now the market's going to fall flat on its face. The economy is going to fall flat on its face. And so my thinking is that it'll take 2 to 3 years for us to get in such a bad recession that the Fed actually has to start printing money again.
Okay.
And that should help us get out of it.
Jeff Hollingworth says, will the Fed withstand the political pressure to reinflate if we lose another 20 to 30%? Loaded question. Lots going on in that question.
So lose 20 to 30% of the stock market?
I suppose so, yeah.
Yeah, I don't think they will yet feel the need to. Or they might feel the need to, but I don't see another 20. Because remember, we're already off the lows by, 15% on the S&P. So, 20% down just takes us a little bit below the recent lows. So for me, it would take, I think you get down 50% on the S&P, that's where they start to feel the pressure.
Okay. Do you think the 2024 American elections will impact the stock markets at all, before or after?
I think it might, maybe marijuana stocks. Maybe if we can get some sort of movement on legalization there.
Right. All right. Mr. Roundo Palladium, price in light of increasing scarcity due much to Russian sanctions, even considering a real long-term threat to price by EVs. So I guess, Russian sanctions and EVs, is there a correlation there?
There might be a little correlation there, yeah, but I think for the most part, again, it's all about demand, right? And if you really are going to see a recession, which again, by the way, this would be the first time that we haven't seen a recession if somehow it happened that way. So I do think you have to go with the idea that a recession is going to happen as the Fed has been hiking rates like this. But you're looking at a scenario where demand destruction probably overcompensates for that. So I don't foresee it as being a big issue.
All right. Well, there's a lot of "Let's Go Brendan" comments in this comment section, so it might as well go there. What is the impact of a Republican administration in 2024? Suppose the tides turn.
See, that's a good question. I think it all has to do with kind of what area of the Republican Party takes over. Is it at the extremist side, or is it kind of the middle of the ground more side? And I think if you're a common sense investor, you don't necessarily, for me, I don't necessarily care if it's Republicans or Democrats. I just want center of the aisle. I don't like the extremist sides on either side.
Okay, fair enough. All right, we have a few minutes left, so let's wrap up, guys. What is your, we got one more question coming in. How low will the real estate market go in 2023? Again, we need your second crystal ball for this one.
Yeah.
But let's just speculate here.
I think by the end of 2023, you're down 20 to 30% from the highs.
From the highs, not current levels.
Well, yeah, and we're just a little bit off the highs, at this point. But I think 2024, you could see more of that.
You know, it's interesting because if you looked at pending home sales as a data series, a lot of people have said that the 2008 housing crisis has collapsed the housing market, but actually pending home sales was in decline as early as 2006. The market was already softening. 2008 was just the kicker.
Right. No, it's true. There's definitely signals in these leading indicators that show, we've seen the rental market be so hot as well. Part of that's the price of homes, right? Price of homes causing rents to go up. But yeah, there's no doubt about it that the housing market, there's going to be, and I'm going to go out even further.
Yeah.
There will be a point in the future where housing prices are down over 50%, but I think you see that later on towards the end of this decade and in the 2030s when you have the baby boomers starting to pass away more and more. And I don't mean to get morbid on that side, but think about how many houses will be coming on the market during that period.
Mm-hmm. That's That is an interesting perspective. Co-op housing is this new buzzing trend that people are looking into, but a lot of people don't want that either.
Is that just having a roommate?
No, it's co-ownership with somebody else.
Okay.
But
man,
I guess
that gets tricky.
Yeah, that does get tricky. But it could be one problem to millennials not being able to afford houses.
Right.
Or one solution to that problem, rather. There's a lot of questions. Well, there's a few questions coming in about the war escalating. I suppose that's referring to the war in Ukraine. Mm-hmm. Let's broaden that scope a little bit more and talk about wars overall around the world. Is there a particular hotspot you're eyeing right now which could potentially blow up and really cause havoc in the markets?
I mean, I think the one we all have to watch for is Taiwan and China, right?
Okay.
I think that's the big one. I think with Russia, you always have to keep that on your radar, but so far it seems to be being kept at a certain level, right? No nuclear weapons used yet. I think that would be the big trigger to freak out the world as a whole if we saw anything like that. So I think at this point, global economic factors, it's China and Taiwan.
Okay. Just on that real quick, and then we'll move on. Is there a risk of a Chinese invasion of Taiwan? There's been a few very senior U.S. military officials going on record saying that 2027 might be the deadline for a Chinese invasion of Taiwan. And the reasoning is that should the U.S. economy continue to grow while the Chinese economy stagnate for whatever reason because their population is stagnating or reaching a peak or their economy is having problems of its own, they have a limited window to actually take action. After that, it becomes more and more difficult.
Yeah, I think there's some truth to that. I think for me, it's you look at what happened with Russia and Ukraine, and I think the idea there was that China was probably planning on doing it a lot sooner. Mm-hmm. And now it's kind of like, okay, listen, that didn't go quite as Russia had planned, so now we need to hold back. And they saw the international community really in an uproar and giving arms to Ukraine. And so I think that's an issue. And then you also look at the economics of what China's going through right now. And to get into a war, to get into something that's going to be even more hard economically, that makes it unlikely in the near term. 2027 is a long way away. It definitely could happen at that point.
Well, I am upset at the prospect of war in any region, but I'm even more upset at the prospect of people not subscribing. If you're watching this right now, why are you not subscribing? Click that button, the red button on the right-hand corner of the screen. I'm going to do one more question, and then we'll move on to your big reveal now. Can emerging markets do well in 2023? You talked about Brazil. What else?
So I think Brazil, China, if it pulls back, and basically a lot of these South American countries. I mean, that's really where I'm focusing on it. For me, it's a chart thing, right? So it's a chart thing. Looking at the charts, the Brazilian chart has this beautiful bull wedge that it hasn't broken out yet. We talked about how it made highs in 2008 and still has not even come close to those highs since. So I think you have to look at that, and then you look at where money has been deployed. And you really want to follow the big money, right? When big money rotates, you want to be on those coattails. And I think that's what we're going to start to see more and more. And so really, I mean, those places, I would say South America looks really good to me.
South America looks good overall. Do they look good overall in terms of their World Cup prospects? Now, that's a question that came in.
I'm no expert in that. I don't see the charts on those.
You are an expert on asset classes and predictions. So what do you think will do well? What do you think will be the best performer in 2023?
So in 2022, we said gold would be Bitcoin and the S&P 500. I'm going to re-up, and I'm going to say gold will again outperform percentage-wise the S&P and Bitcoin. But I will make this further out prediction is after next year, Bitcoin will be the best performer going forward for multiple years.
Okay, so we'll follow up with you after 2023.
Sounds
Gareth,
good.
that's a wrap. Thank you so much for joining us. I really appreciate it. Don't forget to subscribe to Kitco News, and don't forget to check out verifiedinvestingeducation.com. This episode is sponsored by verifiedinvestingeducation.com, and I guarantee you will learn a few new tricks in trading if you visit the site and subscribe to Gareth's service. Thank you again for watching. I'm David Lin. Have a good afternoon.